Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And I'm glad to join everybody back. I safely made it back from Dubai and Egypt for a 2-week trip. And Bruno, I didn't tell you this before, but I actually found out there was an ancient Egyptian prince who apparently had an annuity way back in Mesopotamia and was given almost like a coupon payment every year. But you found some interesting news that we probably should have highlighted earlier around the Nobel Prize and winner. And one more reason why annuities should be looked at by a lot of people.
Right. Well, not that much of a recent news than the Egyptians having annuities, but indeed, Ben Bernanke, who won the Nobel Prize winner not that long ago, joins a long list of Nobel Prize winners who, at the very least, have pushed forward the concept and the implementation of annuities. So I think that's that's another step forward and step in the right direction.
Yeah. Hey, Tisa, how are you?
Great to be here this morning.
Okay. Well, Ramsey, let's see. Can you connect the dots between Nobel Prize winners and Egyptian nobles, perhaps, and annuities and the topic we're going to cover today?
The only thing I can say is that at one point in my freshman or sophomore year in college, Ben Bernanke was teaching me beginning economics. I forget it was introductory macro or introductory micro. So always very, very happy to see him doing well out in the world. And it's interesting. So you mentioned that there was I think you just mentioned there was an Egyptian annuity. My wife handed me an article about a perpetual bond owned by Yale, as it happens, from Holland that dates back to the 1500s. They're still collecting a handful of euros every year on the back of that. So, there are a number of really phenomenal examples. But listen, the most important thing we have going on today is that we are joined by two special people from our lead sponsor, the Index Standard. They've been our lead sponsor for a year now. And for those of you who listen to the show, and at the beginning, I believe we've got a 1-minute intro. We talk about what they do is, they bring clarity to the growing and inherently complex world of indices that are part of the fixed index annuities that so many people that listen to our show are probably involved in selling. So we think it's a very important service, and they're launching some new initiatives as we speak, and that's what we're going to talk about today. So first, I'm going to introduce Branislav Nikolic, right, who is head of insurance at Index Standard. Branislav recently joined from Canex. I'll let him talk a little bit about his new role and his transition. And we're also joined by Jay Watson, who is calling from London. Again, yet further proof that we're an international show. And Jay is head of analytics at Index Standard, and is a longstanding colleague of the founder of Index Standard, Lawrence Black, who's a great friend of the show as well. So with that, Branislav, bring us up to speed. Tell us about your latest.
Thank you, Ramsey. It's my absolute pleasure to be here. Actually, last time I was on the show, it was actually my day 2 or day 3 after joining the Index Standard. So I was really fresh off the boat. So yeah, as you said, like I've joined from Canex, where I was leading research and everything that focused about retirement income planning and annuities and inclusion of annuities, whether it's a retail or in plan. And making a shift to Index Standard, where I really am looking into index solutions in either of the settings, whether it's insurance, it's annuities, index life insurance, and starting to look into in-plan solutions that are more and more willing to look and adopt indexed annuities. So again, pleasure to be here, and looking forward to our chat.
Jay, tell us a little bit more about yourself.
Hi, Ramsey. Thanks for that.
Yeah.
My name is Jay Watson. I joined the Index Standard just under 2 years ago. And prior to that, for best part of 2 decades, I worked in investment banking, most of that at Barclays Capital. And most of that time was spent designing the indices that we're talking about today. So across the different asset classes on a global basis. So I am based in London. That accounts for my accent. And I've known Lawrence for very many years. We were colleagues over the years. And I joined when Lawrence founded the Index Standard. I joined him quite soon afterwards, and I'm very happy to be part of our mission, which is to help people better understand these indices and how they can work well for individuals and retirees.
All right, so why don't we get into it? And by the way, I neglected to acknowledge that. So Bruno is calling from Montreal, and Branislav is normally in Toronto. I don't know where you are today. So Canada is also a very important part of our international presence. So Branislav, tell us about this latest initiative that you're undertaking with the Index Standard.
Yeah. So what we have done at Index Standard, and again, even before I joined, I know what a core mission was, as Jay said, to help people understand complex indices better, understand how they impact the insurance solutions, and more importantly, how they impact the retail products that end up in the hands of moms and pops. So what we do is kind of like multi-layered. So just to kind of remind those who've heard of us, or kind of introduce it to those who haven't, we offer ratings and forecasts for indices. And with our ratings, we are trying to show how well designed or how robust indices are, and talk about their overall design, kind of bring those in common language, simple to understand. And with a forecast, we are trying to rely on what we call the wisdom of Wall Street, and basically try and see how these are going to perform over next little while. In other words, we'll take an index, we'll do a DNA analysis on it, see how it relates to the capital market assumptions that are coming from big insurance companies, banks, asset managers, and see how the indices themselves would react going forward. Now that's all good, but the main question that we've been asked was around how do I apply that in annuities? And there was a lot of work and kind of trying to figure out what's the simplest way, what's the way that would make sense to a mom and pop, to my grandma, that I always like to bring in these scenarios, that she would understand what we are talking about, right? So we first wanted to put these index forecasts to annuity designs and see if we can get a forecast for the annuities based on annuity parameters that are different from different carriers, different surrender periods, and so on, and get the forecast, or what we call net forecast credit, for the annuities. But then soon after, the question really started to be asked is, how do I know where to allocate my money within an annuity? So we understand that these indices themselves are like mini portfolios that are highly optimized to react to different market events, target different levels of volatility. But now that I have many of these mini portfolios and many of the trading strategies within an annuity, how do I allocate within the annuity? And how do I avoid redundancies? A lot of people were saying that they're seeing either binary allocations to, let's say, S&P 500 cap strategy, or if there are multiple options, they would say, oh, we have 5 options. Oh, I'll split it 5 ways. You have 3 options. I'll split it 3 ways. And what we wanted to bring some rigor is how do you do that methodically, but then still keep it simple enough so people who are at the receiving end of this can get something out of it.
So if we take it, from to your point, from your grandmother's perspective, now let's start with the first step, indices. If I'm presented as a consumer between 2 different indices, what would be the differentiating factor between your gold rating and your neutral rating? Like, what are those differentiating factors between those particular rating of those indices?
Okay, I'll try and answer this, Bruno. The first thing to say is that our rating system is entirely analytical. There's no subjectivity, it's objective. So we look at a very large number of different aspects of the index design. Its performance, its the way it's designed, how many parameters it uses, what underlyings it has, a very, very large number of considerations. And each consideration we score. We then add up that score to get a grand total score for a particular index. And then, once we've got that number, a number out of 100, we compare it with all of the similar indices. So, for example, a dividend index we compare with another dividend index, or a multi-asset index we compare with another multi-asset, with a set of multi-asset indices. So we compare like with like, apples with apples. So there's an analytic score, and then with that score, we compare that score with the other similar indices, and then we produce we bucket those scores. The top ones get platinum, the next group get gold, and so on and so on. So it's an analytical process that takes into account a great many different aspects of the index design, and then we rate that index versus its peers.
How does time factor into your analysis, and particularly my time? You know, if I am planning to retire, say 20 years from now versus 10 years, one index may be gold. I would presume, and please tell me this, I would think one index may be gold because it consistently returns a sort of narrow range of fairly good outcomes, or has in the past, and we project it forward. Another one may actually produce some really incredible outcomes if you look over a period of, say, 10 years. But if we start to narrow down that range of time and say, well, Paul, you might be starting to think about retirement sooner rather than later, I'm taking a little bit of a risk that I'm not going to get a period of time where this particular indice has generated very high returns.
That's a very good question. We don't have a crystal ball. We'd love to have, but we don't. What we're trying to do with our index ratings is figure out which indices are well engineered and therefore more likely to do well over the long term versus those that are perhaps less well engineered. They may look good in their backtesting phase when they were designed, but may perform less well into the future when they go live. So that's the first thing. It's not a crystal ball, but it's a figure of a measure of quality. The second thing is to say, we always advocate this, and it's nothing new, diversification. Very simply, do not put all of your eggs in one basket. There are a great many indices out there that I'm happy to say are very well designed these days. But even so, it makes sense to diversify. So there are some indices that may have a hard time in certain environments. Many indices have had a hard time in the last year with both equities and bonds selling off, a very unusual circumstance. So it's very difficult, it's almost impossible to predict what's going to happen in the future. The best thing you can do is to be diversified. Now, that's exactly the approach that we advocate in our model allocations for the fixed indexed annuities. There are many now that offer multiple indices, and at first sight that becomes bewildering. I can imagine if I'd shown this to my mother, bless her, she would say, look, I've never heard of most of these indices. The S&P, yes. The Bloomberg aggregate, yes. The rest, no. So people are stuck. They're presented with often very good choices, but don't have an informed viewpoint on what to do. So that's where we aim to help.
So I would just comment that that one of the toughest things to do in the world of indices is actually really truly understand, when things are redundant and not. It's really very difficult to do without sort of looking under the hood. One of the examples I remember from sort of my old days was, there's the S&P 500, and then there was the S&P 500 value index, and there was the S&P 500 growth index. The S&P 500 has 500-ish stocks in it, but each of those indices had 300 and some odd stocks in it each. So if you added them together, it didn't actually equal the S&P 500 because there were a lot of stocks that were actually in both indices, right? So, that's why, that is precisely why, the work that you're doing is so important, is because it's really hard to do that without really being able to look under the hood. So, Branislav, I wanted to, get your thoughts or get to your insights on some of the tools you use. So we had a discussion offline where we talked a little bit about different thoughts on some of the analytical tools that are used in this space, Monte Carlo being one of them. So maybe tell us a little bit about sort of the tools you use to do this work, this important work, and maybe what some of the pros and cons are that emerge in the intellectual debate in the financial services industry.
We'll be glad to. Thanks for that. So I think that ties to Paul's question as well, into what happens if we want to retire in 5 years? What happens if we want to retire in 10, 15? You got to have the way to test this out. So the analytical framework that exists, that has been in question over last one or two of your episodes, is Monte Carlo a good approach? And I'll go straight to say that all the models are wrong, some are useful, and there are tools that can do certain things, there are tools that cannot do certain things, but we have ways to test. So the question that Paul asked is what if I want to kind of retire in 5 versus 10 years? I think our general approach to forecasting is that you have to take a long-term view, because the capital market assumptions that are coming from investment banks or asset managers are 10-year capital market assumptions. So if you do our DNA analysis on an index, apply capital markets assumptions to it, you get 10-year forecast for an index. So it's important to understand that this is not how index will do tomorrow, 6 months from now, 2 years from now, that this is a relatively long view on an index. Part of what goes into our process is simulating the outcomes, basically taking the capital market assumptions, aligning them with our index DNA, and kind of seeing what a future holds. Now, I would think that that's appropriate and good use of simulation framework. I think more importantly is how you present your results. I think that any tool is very dangerous. It could become very dangerous if you either unknowingly or, God forbid, deliberately misrepresent the results out of a tool, or even if you as a user don't understand. So the analogy that what you're referring to in a couple episodes back was that what came out on, let's say, LinkedIn was, let's ban Monte Carlo. You ban Monte Carlo, 3/4 of the finance will halt next day, and people would say, yeah, why? This worked for a long time, worked in so many contexts, and it's working very well. Now there's the aspect where we say, advisors usually use these to convey the message. Advisors misinterpret the results, and to me that's like saying car is a bad idea because you give car to my toddler. That can be dangerous, but it's very useful otherwise. So that's where we stand. So what we do is we take capital market assumptions from the market, what we call the wisdom of the Wall Street. We apply this to the set of analytical tools to identify exposures of the indices, then simulate based on capital market assumptions and those exposures to get the index forecast. And then lastly, we have to what Jay was saying, fully algorithmic way of allocating within annuities, basically using the results in a proper way to come up with the starting allocations for these products.
If I can just jump in here, it's perhaps worth saying that we've been producing these raw forecasts for indices for a couple of years now, and people in general are very interested in them. As a counter to simply looking backwards. It's always interesting to look at history, to have a feel for things, but we try and look forward as well, and that's what our forecasts do for indices. But what we found was people would say, yeah, well, that's great, but what's it going to do when it's in an index, when it's in an annuity, when it's in a crediting strategy? And in particular, we spoke to clients and they say, look, my clients are being presented with a choice of 40% of the S&P over a year, or 175% participation in this bank index I've never heard of. How do I choose? Where do I start? So what we did, this builds on what Branislav explained, we took our raw index forecasts and we simulate what an index will do in a particular crediting strategy. So we take into account the participation, we take into account fees, we take into account the crediting frequency, etc., all of the aspects that are required. We account for all of those, and we run a simulation out over 10 years, and this goes back to Paul's question, to try and get a feel, an understanding of what a given crediting strategy might do. And the results are very striking. There's a big variation in the results depending on the indices, depending on the crediting strategies. And so this is, we think this is very useful information. And it's the basis of these are our net forecast credits. And we use that, as Branislav pointed out, as the basis for our model allocations among those crediting strategies in a given FIA.
Yeah, it's
Ramsey, one thing.
Go ahead, Branislav.
Go ahead.
Ramsey, one thing that you asked, and I think it's worth mentioning here, is that we are the guardians of assumptions. So we believe that among us, we have enough experience and book know-how to keep the assumptions in check so that they're aligned perfectly. And when we get the capital market assumptions, we don't take it from a single source. We take it from over 50 sources. And we then come up with our own that kind of reflects all of those. So the variation there, we try to smooth it out again to when we apply it into our process. The other one is that we use the results of, let's say, simulations in one step. We don't say, oh, this is going to be a single number. We provide a distributions of results. We pick out moderate, conservative, and strong, and we present all the data. So I think it's also important to talk about what goes into the model, what comes out of the model, and how to interpret it. And with our model allocations as what I refer to as an ultimate cheat sheet on how to use a fixed index annuity, you see that all. You see how you allocate, you see what indices are, you see how indices are rated, you see what the expected forecasted performance of the indices in their raw form is, as well as through the annuity lens or the credit strategy lens. So you have a full story to tell. How does 175% participation, or nowadays numbers that are like in 200, 300, 400s, they're starting to sound like very odd to, again, someone like my grandma. You would say, oh, you'll get 3 times the performance of an index. Are you sure you can do that for me? Like that sounds fishy. I'll go with the one that gives me up to 100%. So all of that kind of mixed together, presented in a clear and concise way, is what we are advocating for, so that the end consumer, end user has a chance of a better outcome.
I have a question. Congratulations on launching the ratings, but I have a question on the design of it behind the scenes. I sit in a marketing seat, so I imagine there's several hours sitting in a room brainstorming and thinking through what you rolled out. The decisions around, or the psychology maybe around, 6 levels versus 8, or 6 levels versus 3 ratings, and sort of using metals versus some other, reference to good, better, best. I'm just curious some of the discussion you may have had there. And my follow-up question to that is, how do you get the consumer who's already skeptical to pick anything other than platinum? Or if something moved from watch to gold, like how do you make them feel like, yeah, this is actually going to, be beneficial to you. It's like, if it's watch, it's always watch forever and always. I'm never going to trust that it moved up. Just sort of curious some of the psychology as you thought through the ratings and the scale.
Okay, that's a great question. You are absolutely right. We did scratch our heads for a long time on this. And we came up with our rating: platinum, gold, silver, copper, neutral, and watch. We wanted something that immediately conveyed, better or less good. We thought about lots of different possibilities, stars. Somebody suggested dollar signs. We thought that was not a good idea. What we wanted to convey was a sense of quality in a very simple way. So I don't know whether we've got that right, but we're going to stick with it. The other question you ask about, should someone only ever choose platinum? The answer to that is no. Broadly speaking, the top 3 or 4 of our 6 categories, they're all good. Yeah, but the platinum we think is the best. All of the platinum, gold, silver, those are all really well-engineered indices. So you should be confident with any of those. And in particular, those ratings, they do move around through time. If an index is platinum, it doesn't necessarily say platinum forever. We take into account in the analysis of that score, that rating, we take into account the forecast performance of the index, also its live performance compared to its back-tested performance. So as an index becomes live for longer and longer, we give more weight to that live performance. If that's good, then that will have a greater weighting. So if an index is rated silver, say, it may go up. So the ratings do change, not very much. They're broadly stable, but they do change from month to month. But they do not lurch from platinum down to watch, back up to gold again. There's no yo-yoing around. We were confident when we designed the scoring structure that it would be stable, but it would move gently over time, if appropriate.
Yeah, I do think communicating potential outcomes is incredibly complicated. Love the idea of an icon. Now, I think of how we show ranges of outcomes today, and it's difficult. I think on our illustrations, Tisa, I think we show best, worst, and last. And ironically, the last can actually be better than the best, just the way the illustration rules work. And I'll try to explain that to a 6-year-old consumer. Another one way we've looked at this, Branislav, I think I've shared some of this work with you. We've looked at distribution of outcomes. Now, we've been doing this, in a mirror, looking backwards. And you start to get some very interesting results. Some of these indices generate, if you're thinking of a normal distribution curve, very wide tails, some very high peaks. So, I'm sure there are many caveats, but all things being equal, you have an index. The goal of any type of guide should be, in my mind, to help a 60-year-old safely achieve their retirement objective. Now, suppose we have Fund A that, say, shows or projects it will generate, on average, say, a 6% return with a standard deviation of, say, 1 or 2%. So low but very tight curve of outcomes. And we have almost same exact indice with averages 9%, but the standard deviation is wider, meaning the chances of going, lower than that more conservative fund it could happen. Which one gets platinum and which one gets gold? Or have I just totally trashed and walked over your model?
So you opened two very important questions. I think you should the last one, but I think you opened the very two very important questions. One is about the sales practices and illustration practices, which we can get into. And the other one is, what's the preference? You started talking like means and standard deviations, and I did some math in my schooling, but the key here is that my grandma doesn't understand a single word that you just said. So I think what may work for someone like her is like, are you preferring index that's hitting singles and doubles in baseball terms, or you're looking for someone who's hitting home runs? And which you prefer, it's your thing. On average, they're going to have the same number of runs in the season, yada, 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 take a long term. So that's the first thing. But the other one is that you mentioned illustration practices, and I'm passionate about this one. It's that I think they're kind of product of their time. If you go back to when NAIC rules came about, it was like in early 2010s, it was just about 2008. And I think the last really meant to show if 2008 happened, what would the outcome be? Now you move that rolling window away from 2008, and last really becomes that you're looking into the raging bull market that we've seen. Now you're starting to see a little bit of 2020 or 2022 coming in, but overall, like 8 out of those 10 years are still phenomenal. So I think those are due to be adjusted to kind of prevent what I think is cheating. That's something that was meant to do a good thing, include a widely bad outcome in those illustrations. Now, in its place, you are seeing the best possible thing that happened to you. So that. And then the third question that you asked is about how does the performance impact our rating? So I'll go ahead and ask Jay to give you the explanation there, because that's basically the difference between ratings and forecasts.
Yeah, the answer, Paul, is we do take into account our forecasts, but it's only one of the things we look at. We're not just looking for the index with the highest forecast, put all your eggs in that basket. That's not the approach we advocate. As I say, we're trying to give an appraisal of how well engineered an index is. How robust it is. Is it likely or less likely to do what it's supposed to do? That's what we're looking for. And so to your question, should somebody choose 6% return, expected return with a vol of 1.5? By the way, that would be, if you could find that index, tell me, that's amazing. Versus 9% with a vol of, I can't remember what, higher. It depends. It's the preference, as Branislav says, it's the preference of the end investor. And that's where the advisors come in helping those end clients make a decision. Are you happy with singles? Or are you happy with nothing, and then maybe the occasional home run? It's up to the client. So our role, as we see it, is to try and put in front of people that information to help them make an informed choice. And help guide their end clients to what is most appropriate for those end clients.
So Jay, is it fair if I simplify it maybe the other way, that if you look into our ratings, that will tell you, that will describe the index. It would take everything that an index has to offer into consideration, and it would kind of tell you whether the index keeps its promise. In other words, whether the design that showed very well in design phase or backtest phase carried into the future, whether the mechanism works as described, how are the metrics coming out for the index mechanisms. And then you combine that with a forecast where you then can compare the forward-looking view on how the index would perform. And you would say, ideally, you would pick like metal index, platinum, gold, or silver with a very stable return profile in the forecast that doesn't deviate much between conservative, moderate, or strong. And then you look into the past and say that now, last 10 years or last 20 years, this index was returning 5 or 6%. Forward looking, we see somewhere between 4 and 7. That means that's indicative of what might have happened. But I think that's harder to gauge once you get into the annuity. And I think this is the last piece. And this, I was hoping that was your question, like, how much you were kind of spending in the room thinking about how to simplify an allocation with an annuity, and how do you present those results. So maybe we want to talk about that for a quick second. And then Jay, do you want to lead it off, or do you want me just to say that again, the idea was there to make it simple, make it algorithmic again. So there is no secret sauce in it. Everything is there. Everything is disclosed. And we want to give the option, especially in today's higher than what we've seen over the last 10 years interest rate environment, given that FIAs are still fixed annuities, how much of above and beyond the fixed rates are these strategies bringing to the table? And should you consider the fixed rate that it's now short history, but historically high and whatnot? So, Jay, do you want to maybe talk about the process for a little bit?
Yeah, sure. Thanks, Branislav. So, again, we're acutely aware that people are presented with a long list of choices, which are going to be very difficult to understand. These strange terms, unusual indices, strange indices. What we do for every single crediting strategy is calculate the expected returns of that crediting strategy. So, in fact, we calculate the moderate and also a conservative and a strong number, sort of weaker, the expected value, and then in a good scenario. We do that for each index, each crediting strategy linked to each index. So that's the first step. And it's a big effort. So there might be 5, 6, there might be 20 different crediting strategies across 3, 4, 5 indices. For each index, we pick out the crediting strategy with the highest expected return. This is the selection part of the process. So for each index, look at the crediting strategy linked to it and pick the one with the highest expected return. Next step, check, is that higher than the fixed rate? It jolly well ought to be, because if it's not higher than the fixed rate, why would you take the risk of allocating to an index which the expected return is less than the fixed rate? So if it's less than the fixed rate, we throw it away, we discard it. We also discard an index if the best of its crediting strategies, the expected return is substantially less than the best available in that FIA. So there's a big selection process. We try and sort out the wheat from the chaff, if you like. Once we've made that selection, we then have 2 possible model allocations we propose. Both of them are fundamentally simple, and both of them are based on the idea of diversification. So having made that selection, in our first model, we just allocate equally to each of those selected indices. Very, very simple. The other model is a little bit more sophisticated. We tilt the allocations according to the forecast, the expected returns, our forecast for those crediting strategies. And so if the forecast expected return is higher, we give it more weight. If it's less, we give it less weight. So you're taking a little bit of a view according to the expected returns. But in both cases, the selection is the same. The selection is looking to pick out, for each index, the crediting strategies which over the long term we think our calculations show, demonstrate, indicate will produce the highest returns over the long term. Does that make sense, everyone?
Yes, absolutely, and it's a very complex approach, obviously, to help, again, to take Branislav's grandma and everybody else out there, of course. You touched on diversification significantly earlier on. How is diversification achieved in the context of what you just said, like having that algorithm picking and choosing different, comparing the expected return? How is diversification achieved through this process?
Okay, well, let me express it a different way. What we don't do. You might be tempted, if you have for every crediting strategy, the expected return, say, aha, there's the highest one, let's put everything in that. We don't think that's sensible. What we do is, for each index, we allocate, we check the best crediting strategy for that index is not below the fixed rate or not too low. And then if assuming that's okay, then it gets an allocation. That's the diversification. We allocate to all of the indices where the crediting strategies are good to very good.
So my comment, so Bruno, or actually, did you have another follow on there before I jump in? I was just going to say, Bruno, yes, it is a complex process, but it's also a complex problem, right? So indices, even simple indices, have complexity, some of which I alluded to before. And then, many of the indices that are in this space, are even more complex because they've got lots of different rules and they've got volatility controls and lots of things like that. And so then there's a process of evaluating them at that level. And then you put them into an FIA chassis, and suddenly you have all these, right, asymmetries that are brought in because you've got caps and things. So, I mean, I don't know how one could actually sort of see fit to be able to optimize any of this without a very strong quantitative model, which kind of brings us back to where we were with Branislav earlier, right? Is at the end of the day, you need a model, right? You need a model. And then to the extent that you have a model, the discussion comes down to how robust are your inputs and your methodology. And so, right, this whole discussion is really about you're describing the care that you put into those two critical elements to using this, right, this sort of widely accepted way of evaluating the economic opportunity. So anyway, that's my 25-cent summary. But did I miss anything there, Branislav?
I think you get it right on. And then Bruno, just to kind of try to answer your question, because again, I think the question that you asked sounded simple, but I hear it as a very deep consequences. So one thing is that we try to beat out redundancies in terms of strategies on the same index. Because again, those could be redundant, those could be all ratings. So for example, if you have an index and you have two strategies that perform the best, you could say, oh, give me half of one, half of the other. You did not diversify. You just chose two different payout structures on the same index. So that's the first step how diversification comes into play. But we also rely on diversification is that the carriers, when they're putting these indices in, they're usually not redundant. So you wouldn't have indices that are kind of carbon copy replica of one another within the annuity. And the third one is diversification with respect to the fixed rate. If fixed rate is favorable compared to those well-performing strategies. So that is on a three levels of diversification that this offers. Now, could you go deeper? Could you try to optimize? I use a term that Ramsey brought up, optimize. How can you optimize this? I think when you say optimize, people always go to Markowitz and more portfolio theory and mean variance optimization. And the key with a fixed index annuity is that allows us to be a little bit simpler, to use a little bit more of a heuristic approach, if you want to call it, is that you cannot lose money. These are principal protected products, and you can really look into what's the difference in my upside. Now you want to do this for, let's say, registered index annuities that you can lose the money. You definitely have to start measuring the downside and then compare upside and downside. And this would kind of add you another level of diversification. Do you want to go for strategies where you win big but lose big occasionally, or you want to go for a more stable return? So I think you're asking a very deep question. We're trying to, in the context of fixed index annuities, answer it with a very simple solution, but there's a lot of things that are going in the background.
Yeah, this is a real problem in our business that you are all solving. And we've been to conferences, I've talked to IMOs, we've talked to some of our top agents, and index selection is a very important issue, I think, that really could benefit from, more support in the industry with tools like yours. I think last year, the combination of bonds being down with stocks really hurt a lot of these low vol indices. And I think the knee-jerk reaction, as I've heard from some agents, is, I'm just going to put everything on the S&P 500. Well, that's not the right solution for your clients necessarily.
But you see, sorry, I have to jump in. You're saying two things. You're saying vol control indices didn't work well last year, but going forward, I'm going to put them into S&P.
Exactly.
The S&P did last year.
I know, Branislav.
These indices did a bit better than S&P.
Right, and going back to Ramsey's point, we need structure around this, and this is not we're not trying to time the market inside fixed index annuities, nor should we. We need, Jay, that perspective look that encourages, behavior that creates outcomes that the products are designed to deliver. So I know we've got a lot more we could talk about, Ramsey. A lot more, but we're at the top of the hour. Tisa, do you have any last thoughts or comments on this topic?
I think we all agree it's complex, right? And so I think this rating system helps to demystify it, break it down, make it simpler. So it's interesting to hear, some of the thoughts that went into building it, and I think it's a step in the right direction, right, to help the industry and to help the end consumer understand or make a decision in a different way.
Oh, yeah, I agree. I'd like to see some of our products and see the ratings you have here.
Yeah.
Bruno, your last thoughts.
Yeah, well, I certainly applaud the endeavor and the initiative. I know I was in similar position not that long ago, and when things are going well and platinum and gold continue to be platinum and gold, you don't necessarily get the medal. But when the boat starts rocking, then that's when you get the tough question. So it's a tough, it's a very difficult challenge, and at the risk of stating the obvious, in a complex environment. So I applaud the initiative. Well done.
Ramsey, bring us home.
So thanks again to Branislav and Jay for being here, and hopefully I sort of pre-summarized my thoughts earlier. Tissa, I think that your question earlier about marketing this and the way it's communicated is super important, right? There's everything about this challenge and opportunity is, it requires a lot of thought. Everything from, right, the quantitative progression to how we ultimately end up communicating it to the channel. So thanks to everybody for another great episode, and thanks to the Index Standard for being such a great sponsor and friend of the show for the last year.
Yeah.
A pleasure. Thank you.
Hey, thank you all. And want to again thank our listeners. Listen, send us feedback, call us. I get texts, I get calls. I know everyone else does. And give us your opinions. And we will continue this discussion on this topic. I think it's really important for our business. And join us again next week for another episode of That Annuity Show.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.